Welcome back, RMJ. Glad to see you're ready to get back into it. So, we're looking at that goodwill calculation for Pat and Slap. From where we left off, we've got the task of figuring out exactly how much extra value Pat is paying for Slap's business. Based on your notes, we need to find the difference between the price paid plus the non controlling interest and the net assets we're actually getting. Should we start by breaking down the group structure and the dates involved, or do you want to jump straight into the math?
All right, let's get this session moving. First thing, we need our master formula for goodwill. It's essentially the extra money paid over what the company's parts are actually worth. Before we crunch numbers, we have to look at the structure from your materials. Pat bought 80% of Slap on September 30th, 20x7. Since Pat owns 80%, the non-controlling interest, or NCI, owns the remaining 20%. This date is huge because we only care about what Slap was worth on that specific day. Now, let's grab our first number. The consideration transferred is just a fancy way of saying the price Pat paid. If you look at Pat's column in the statement of financial position under investment in Slap, you'll see 4,000. Since the table is in thousands, that is $4 million. Does it make sense why we use Pat's investment figure here? Great question. On Pat's own books, that 4,000 represents the cash or value they gave up to get Slap shares. But when we consolidate, we aren't just looking at Pat as a shareholder. We're treating Pat and Slap as one big happy family. So we take that 4,000 cost out and replace it with everything Slap actually owns. The consideration is just our starting point for checking if Pat overpaid or got a deal. Ready to find out what the 20% owner's share is worth? Spot on! You really know your stuff. You are exactly right. The investment is internal, so it has to disappear in the final consolidated balance sheet. But to make it disappear correctly, we have to compare it to what we bought. Think of it like this. The 4,000 investment is what Pat gave, and the net assets are what Pat got. The difference between those two, the part that doesn't cancel out perfectly, is our goodwill. We used that investment number one last time just to do the math for the gap. Makes sense why we need it for the calculation, even though it won't show up on the final group report. Boom. Let's move to the NCI. This is the value of the 20% of Slap that Pat does not own. We need to include this because we're valuing the whole business. So, we take the 1,000 shares from Slap's share capital, multiply by that 20% slice, and then multiply by the $4.50 market price given in your notes. That gives us 900. Still with me on how we got that 900 for the NCI? You got it. No skipping steps here. For the NCI, the equation is the total number of shares in Slap times the percentage Pat doesn't own, all multiplied by the market price per share at the date of acquisition. That 1,000 comes straight from Slap's share capital in your notes. Since they are $1 shares, $1,000 equals 1,000 shares. We multiply by 20% because Pat bought 80%. And the $4.50 was given right in the first paragraph of your activity. Does that step-by-step breakdown of the NCI equation look clear to you? Ah, I see the confusion. You're thinking of the proportionate share method where you just take the NCI percentage of the sub's net assets. But in this specific problem, your notes use the fair value method because they gave us a specific share price of $4.50. Think of it like this. If you know the actual market price of the shares, that's considered better info than just estimating it based on the book value of the assets. So, we use the share price method here because the problem explicitly handed it to us. Does that clear up why we aren't doing the percentage of net assets this time? Perfect. Now we need the net assets at acquisition. This is basically the value of SLAP on the day Pat bought it. The formula is just the sum of SLAP's equity accounts, share capital plus share premium plus retained earnings, but only the earnings they had up to the day of the sale. From the SLAP column in your notes, we can pull two of these immediately. Share capital is 1,000 and share premium is 500. But check this out. The retained earnings on the balance sheet is for the end of the year. We need the value on September 30th. Ready to see how we track that back in time? Alright, this is the tricky part where most people slip up. We need to find out how much profit SLAP had earned by September 30th. The year starts on January 1st, and Pat bought SLAP on September 30th. That is exactly 9 months of profit. We take the starting retained earnings of $1,500, which I grabbed straight from the SLAP column in your notes. Then, we take SLAP's full year profit of $1,000 and multiply it by 9/12 to get $750. Add those together, and we get $2,250 for the retained earnings on the day of the takeover. Does that 9-month split make sense to you? Aha! That's a classic trap. When we are calculating goodwill, we are strictly looking at the price tag of the company being bought, which is SLAP. We want to know if the price Pat paid is more than what SLAP was worth. Pat's own retained earnings are totally separate. They'll show up later when we do the big group total, but they don't affect how much goodwill was created when the deal happened. You're buying a car, you don't look at your own bank balance to figure out the value of the car, right? Does that help separate the two in your mind? All right, let's wrap up the net assets. We add the share capital of 1,000, the share premium of 500, and the 2,250 in retained earnings we just calculated. That gives us a grand total of 3,750 for the value of SLAP's stuff on the day of the sale. We're in the home stretch now, ready to put it all together into that master goodwill formula. Here we go. We take the price Pat paid, which was $4,000. Add the value of the 20% owners, which was 900. That means the whole business was effectively bought for 4,900. Now, we subtract the actual value of the assets we just calculated, 3,750. The difference is 1,150. That is your goodwill. It's the premium Pat paid for Slap's reputation, brand, or whatever else makes it special. How are you feeling about how we pulled those pieces together? Alright, we crushed it. I've put a quick summary and some flashcards on the board for you to lock this in. Since we finished the goodwill calculation, do you want to move on to calculating the consolidated retained earnings for the whole group? Or is there another part of this activity you want to tackle? You got it. I've pinned the master list of equations right there in the reference column. Equation 1 is our big goal. Equation 2 is how we valued those outside shares using the market price. Equation 3 defines what the company is actually made of. And equation 4 is that time machine math we used to find the earnings on the exact day of the buyout. Seeing them all together like this, does the logic of how we built the final answer start to click? Perfect. Since you've got the equations down and the goodwill calculated, what's our next move? We could dive into calculating the consolidated retained earnings for the group,